As the U.S. market is closed for the weekend, we are looking at the final closing print for Luminar Technologies, ticker LAZR, from Friday, October 24th, 2025. The stock finished the session at $2.22 per share. That represents a staggering, explosive move of 53 cents, or 31.36% to the upside. Now, if you just glanced at that number, you might assume the company announced it had tripled its order book or finally solved its profitability problem. The immediate expectation is that some fundamental piece of the business has dramatically improved. But the reality of what likely caused this move is far more complex and, frankly, far more speculative. This wasn't a press release about a new design win. This was a violent reaction to market narrative, specifically chatter about founder Austin Russell making a potential bid to reclaim the company. This 31.36% spike on massive volume looks less like a sober re-evaluation of the company's prospects and more like a classic brutal short squeeze, ignited by a story that hits all the right notes: the return of the visionary founder to save his creation. Let's be perfectly clear about the expectation that has surrounded this company for years. The long-term bull case for Luminar has always been straightforward and seductive. Luminar makes Lidar, the eyes for autonomous vehicles. They have, by many accounts, a superior technology using a 1550 nanometer wavelength, which provides longer range and better performance than competitors. They locked in huge, high-profile partnerships with giants like Mercedes-Benz and Volvo. The story was simple. As these automakers ramp up production of high-end autonomous vehicles, they will buy thousands, then hundreds of thousands, then millions of Luminar sensors. The revenue would scale exponentially, and this tiny company would become an indispensable supplier to the global auto industry, an NVIDIA stock equivalent for vehicle perception. That has been the expectation. Investors, whether they are doing self-investing or getting investment help, have been holding on for that massive payday, believing that patience would be rewarded. Now, let's slam into the reality of the numbers, the facts that have defined this stock's brutal downtrend over the last year. A downtrend that yesterday's 31.36% spike is fighting against. The reality is that Luminar is in a financially precarious position. As of its last quarterly report, the Q2 2025 numbers, the company's financial health was deteriorating, not improving. Revenue for that quarter actually decreased 5% year over year to just $15.6 million. Worse, the company was forced to slash its full year 2025 revenue guidance. They chopped it down from a range of $82 to $90 million to a new, lower range of $67 to $74 million. The reasons? Slower than expected adoption by the automakers, the very partners the bull case rests on. And perhaps more painfully, the winding down of a high-margin data contract that was helping to pad the numbers. This brings us to the most critical number of all: cash burn. In the first 6 months of 2025, Luminar used $97.9 million in cash just for its operating activities. As of that report, it had only $108 million in cash and marketable securities left. This is not a comfortable cushion. This is a countdown clock. The company itself has acknowledged it may need to raise up to $100 million more just to reach profitability, which is still a distant target. So you have a company that is burning through nearly $100 million in 6 months while holding just over that amount in the bank. You have slowing revenue and cut guidance. This fundamental backdrop is why just before yesterday's spike, the stock was languishing at $169. It's why, according to the latest data, the short interest in Luminar is sky high, sitting at over 20% of the float. A massive number of institutional investors, the kind using sophisticated interactive brokers trading platforms or managing Fidelity mutual funds, have looked at that balance sheet and made a direct bet that the stock is going to zero. They are betting that the company cannot bridge the gap between its current burn rate and the future hoped-for revenue from its big partnerships. This isn't like buying Apple stock or Tesla stock, which are backed by massive profits and proven business models. An investment in Luminar at this stage is a high-risk speculation on technology that has not yet proven it can be manufactured profitably at scale. Into this powder keg of high short interest and dire financials comes the rumor of the founder's return. The volume on Friday was astounding. 26.89 million shares changed hands. The average volume for this stock is closer to 5 or 6 million. This tells you exactly what happened. The rumor hit the wires, and automated trading algorithms, combined with retail traders on the Robinhood app or using SoFi Invest, saw the spark. Simultaneously, the short sellers saw their positions exploding in their faces. Anyone short at 170 was suddenly violently underwater. They were forced to buy back shares at $180, $2, $210, all the way up to the high of $228 just to close their positions and stop the bleeding. This forced buying, known as a short squeeze, has nothing to do with Luminar's cash on hand or its revenue guidance. It is a purely technical event, a dislocation driven by a powerful narrative. The question for anyone looking at this stock right now, whether they're a self-investing pro or just starting with online investing, is whether this 31.36% spike is the start of a real turnaround or just a painful one-day reckoning for the shorts. Let's briefly touch on what the company actually does, because the technology is impressive, even if the business model is struggling. Luminar designs and builds Lidar systems. Lidar stands for Light Detection and Ranging. It shoots out pulses of laser light and measures how long they take to bounce back, creating a perfect, real-time 3D map of the world. As mentioned, Luminar's key differentiator is its 1550 nanometer wavelength. Most competitors use 905 nanometer lasers. The 1550 nanometer wavelength is considered eye-safe at much higher power levels, which allows Luminar to see further, over 200 meters, and with better resolution, even in bad weather. This is why Mercedes and Volvo signed on. They believe this capability is essential for true highway autonomy. The company's entire existence is a bet against the Tesla stock philosophy. Tesla famously argues that Lidar is a fool's errand, and that passive vision, using cameras just like human eyes, is the only way to solve autonomous driving. This creates a massive technological divide in the auto sector. If Tesla is right, companies like Luminar are worthless. If Tesla is wrong, and the rest of the industry decides Lidar is essential for safety, Luminar holds a key piece of the puzzle. The problem is that holding that piece is costing them hundreds of millions of dollars they don't have. This is what makes the future outlook so binary and so fascinating. We are witnessing a war between expectation and reality, and yesterday the expectation won. Let's map out the two possible scenarios. Scenario 1, the bullish expectation. The Austin Russell news is real. He puts together a financing package, takes a more active role, and injects new capital and a new strategic vision. Luminar 2.0. This new funding bridges the valley of death, giving the company the 12 to 24 months it needs to get its Thailand-based manufacturing facility fully ramped up, which is supposed to cut production costs by a few $100s per sensor. The capital infusion removes the insolvency risk, forcing a permanent unwind of the massive short position and allowing the stock to trade on its future potential, not its current cash burn crisis. In this scenario, the move to 222 is just the beginning. Now for scenario 2, the bearish reality. The Austin Russell news is just a rumor, or it's a bid that ultimately fails, or it happens but doesn't come with enough new capital. In this case, nothing has changed. The 31.36 pop was just a one-day squeeze, and the focus will snap right back to the fundamentals. The next earnings report, expected around November 10th, will be the moment of truth. Analysts will ask one question: what is the cash burn and how many months do you have left? The analyst consensus right now is a sell, with an average price target of just $1. They believe the company is heading towards dilution, or worse, bankruptcy. This is the cold water of financial reality. If this is the case, anyone who bought at 222, chasing the spike, will be left holding the bag as the stock resumes its slide. This is the danger of chasing parabolic moves in heavily shorted stocks. It's not online investing.